In 1929, the world discovered just how quickly prosperity can collapse into fear. One moment, Wall Street looked unstoppable. The next, it lay in ruins. Vast fortunes disappeared almost overnight. Banks shut their doors without warning. Millions of people watched their savings, their jobs, and their security evaporate. Most people remember it as a single historic catastrophe, a dark chapter that ended long ago. But what if it never truly ended? What if the same forces that triggered the Great Depression are quietly shaping your reality today? If you've ever asked yourself why prices keep climbing, why owning a home feels out of reach, or why debt grows faster than paychecks, you're not alone. None of this is random. What you're seeing is the echo of a system built on risk, greed, and illusion. Before we go further, tell me in the comments where you're watching from and what time it is for you right now. I love seeing how far these stories travel across the globe. And if content like this resonates with you, make sure you subscribe, because today's story will change how you look at every headline about money markets and power. Now let's return to 1929. The world was riding a powerful wave of excitement and confidence. Stock prices were climbing nonstop. Ordinary people, teachers, farmers, mechanics, were buying shares on margin, borrowing money to gamble in a market that seemed incapable of falling. Newspapers praised it as a new era of wealth. Does that sound familiar? Everyone believed the old rules no longer mattered. Technology was advancing rapidly. Credit was easy to get. Politicians promised endless growth and permanent prosperity. And quietly, beneath the optimism, the same pattern was taking shape. Debt piled on top of debt, held together by confidence alone. In the years before the crash, speculation went far beyond stocks. Real estate surged. Banks handed out loans with little caution. Companies exaggerated their profits. Consumers purchased luxuries through installment plans. It was a culture of optimism financed almost entirely by borrowed money. And like every debt-driven boom in history, it ended the same way, abruptly. In October 1929, panic spread and investors rushed to sell. Prices collapsed. In just days, billions of dollars in paper wealth vanished. The system that once appeared invincible split open, exposing how empty it truly was. But here's the part that matters most today. The crash itself did not cause the Great Depression. It was only a symptom. The real disease was embedded in the economy's structure: too much debt, too little real income, and blind faith in endlessly rising markets. Sound familiar yet again? Today we're watching the same conditions unfold, only under different names. Instead of ticker tape and telegrams, we have trading apps and crypto charts. Instead of margin loans, we rely on credit cards, mortgages, and trillion-dollar deficits. And the illusion has grown even stronger. Modern economies survive on consumption, but consumption relies on confidence, and confidence is fragile. When people trust the system, they borrow, spend, and invest freely. When that trust fades, everything freezes. That's exactly what happened in 1929, and it's what economists worry about today. The real danger isn't the crash itself, but what follows when trust disappears. Because once people stop believing the system will hold, they stop playing the game. Let's talk about debt. In 1929, household debt in the United States had reached unprecedented levels. People bought cars, radios, and homes they couldn't truly afford, convinced wages and prices would keep rising forever. In 2025, global debt exceeds 300% of total world GDP. The pattern hasn't changed. We're still using tomorrow's money to survive today. Back then, banks sold risky loans disguised as opportunity. Today, they do the same through complex financial products. The tools evolve, but human psychology stays the same. During the 1920s, inequality hit historic extremes. A small elite controlled most of the nation's wealth, while the working class lived on credit and hope. When the bubble burst, they had nothing to fall back on. Look around now. The top 1% owns more wealth than the bottom 90% combined. Corporate profits shatter records while wages barely move. The middle class is squeezed, turning to debt just to stay afloat. It's the same script, rewritten for a new century. In the late 1920s, the Federal Reserve kept interest rates low to fuel growth, then sharply raised them when inflation appeared. The result was a sudden liquidity crunch that strangled credit markets and ignited panic. Today, central banks face the same dilemma: print more money to keep markets alive or raise rates to fight inflation, knowing both choices carry serious consequences. History isn't repeating overnight, it's repeating in slow motion. And then there's speculation. In 1929, people poured their savings into stocks they didn't understand simply because everyone else was doing it. Today, it's meme stocks, NFTs, and crypto bubbles. The psychology is identical: fear of missing out, unchecked greed, and the belief that easy wealth is guaranteed. When prices rise, people assume it's skill. When prices fall, they realize it was luck. The Great Depression revealed an uncomfortable reality. When systems become too unequal and too heavily leveraged, they eventually collapse under their own weight. The real question isn't whether it will happen, but when. And if we're honest, most economies today are running on borrowed confidence. The warning signs are everywhere: record household debt, rising corporate defaults, and governments creating money at unprecedented speed. But there is one critical difference. In 1929, the financial system was much smaller. When it failed, millions suffered. Today, the system is global. A shock in one country can ripple across continents in seconds. That makes the stakes far higher. What happened in 1929 wasn't just a financial breakdown. It was a failure of imagination. People believed prosperity was permanent. They couldn't see how fragile the system really was. Today, we're making the same mistake, trusting central banks and politicians to hold everything together. But stability built on debt and speculation isn't stability at all. It's borrowed time. The lesson of 1929 wasn't absorbed. It was forgotten. Because every generation believes it's smarter than the last, that it has built a safer system, that this time is different, but the patterns tell a different story. The Great Depression began with a handful of terrible days on Wall Street. It ended with years of suffering, deflation, and shattered trust. The real danger isn't history repeating itself. It's us repeating history. And if the same forces are returning, the question becomes simple: what happens when the illusion breaks again? By the early 1930s, that illusion had completely collapsed. Bread lines wrapped around city blocks. Thousands of banks failed. Families lost their homes, their savings, and their sense of security. What started as a financial panic turned into a full-scale social crisis. Governments rushed to respond, but their tools were crude. They cut spending to balance budgets, raised tariffs to shield industries, and watched unemployment surge. In trying to avoid short-term chaos, they made the collapse even worse. The Great Depression became a decade-long scar that reshaped politics, economics, and faith in capitalism itself. But here's the uncomfortable part. The same logic is visible today. When cracks appear, policymakers reach for the same solutions. They print money, slash interest rates, and promise stability. They treat the symptoms, not the disease. The global economy now floats on mountains of debt that will never fully be repaid, held together by central bank intervention and public belief. And that belief is fragile. When it breaks, history doesn't repeat itself. It rhymes. Look at speculation. In the 1920s, leverage fueled the frenzy. Investors borrowed up to 90% of the value of their stocks. When prices dipped even slightly, loans were called in. Margin calls spread rapidly, forcing mass sell-offs and accelerating the collapse. In modern markets, leverage hides behind complexity. Hedge funds, derivatives, and shadow banking systems amplify small shocks into systemic threats. The tools have changed, but the core danger hasn't. Too much risk, too little transparency, and too much faith in models built on fragile assumptions. When reality shifts, those assumptions fall apart. During the Great Depression, trust collapsed first in markets, then in institutions. Banks shut their doors overnight, leaving depositors with nothing. In response, the U.S. government created the FDIC to protect deposits. For a time it worked, but today the scale is entirely different. Banking is global. When Silicon Valley Bank failed in 2023, fear spread instantly across borders. The same anxiety about hidden losses and disappearing safety still lingers beneath the surface. What made 1929 so dangerous wasn't only financial, it was psychological. The belief in endless progress had become a kind of religion. Prosperity felt inevitable. When that belief shattered, people didn't just lose money, they lost trust in the system itself. The danger today is strikingly similar. For decades, we've been told central banks can control economic cycles, that policymakers can smooth every downturn, that recessions are relics of the past. Yet every fix demands more debt, more intervention, and more distortion. Each rescue plants the seeds of the next collapse. The Great Depression also revealed how deeply interconnected the global economy had become. When U.S. markets fell, European banks, already crushed by war debt, collapsed. Germany spiraled into crisis. That economic breakdown fueled resentment, extremism, and political chaos. The world learned that economic pain doesn't stay contained. Now fast forward to today. Global debt exceeds $300 trillion. A crisis anywhere, a sovereign default, a currency collapse, a failed bank, can ripple instantly across the globe. The structure is bigger but no stronger. In 1929, policymakers believed they could restore confidence with speeches and limited interventions. They misdiagnosed the illness. It wasn't panic driving the collapse, it was leverage. People weren't acting irrationally, they were dangerously overexposed. The same principle applies today. Central banks flood markets with liquidity, hoping confidence will rebuild on its own. But liquidity is not the same as solvency. Creating money doesn't generate real value. It only postpones the recognition of losses, and the longer that reckoning is delayed, the more severe the eventual correction becomes. Here's another clear echo. In the 1920s, asset prices surged far beyond their underlying fundamentals. Investors justified it by insisting that this time was different. They believed new technology, smarter management, and modern policy had made the old rules irrelevant. Sound familiar? Today, valuations once again defy logic. Companies lose billions yet trade at historic highs because markets assume growth will never end. That same optimism blinds investors to underlying fragility. The names change, from RCA and Bethlehem Steel to Tesla and profitless startups, but the mindset is identical. Debt-driven bubbles always conclude the same way. Confidence cracks, credit tightens, prices fall. The only uncertainty is timing. In 1929, the break came suddenly. In modern systems, it may unfold more slowly, concealed by policy support. But math never lies. When debt expands faster than income, repayment becomes impossible. When growth relies on continuous credit expansion, stability becomes an illusion. We're rebuilding the same structure that destroyed the 1920s, only now on a global scale, and there's another parallel. Inequality. Before the crash, the wealth gap was extreme. The wealthy speculated in stocks. The poor survived on installment credit. When the collapse arrived, the pain was uneven. Today, inequality is even more severe. The top 1% controls more than half of global wealth. Asset inflation rewards those who already own assets. Wages stagnate. Debt fills the widening gap. The middle class feels richer as home prices rise, but that wealth is borrowed. When interest rates climb, the illusion disappears. Social tension grows. The Great Depression gave rise to populism and protectionism. People turned inward, blaming outsiders, elites, or systems they didn't understand. We're seeing the same emotions resurface: distrust in institutions, anger over inequality, fear of rapid change. Economic insecurity fuels extremism. History shows what happens when financial pain collides with politics. Back then, governments embraced austerity, cutting spending to restore confidence. It failed. Today, leaders face the opposite danger: unlimited spending funded by money creation. Both paths end badly. One leads to deflation and despair, the other to inflation and decay. Lasting prosperity requires balance. Debt must support production, not speculation. Policy must prioritize long-term stability over short-term boosts, but political incentives reward the opposite behavior. In 1929, speculation was visible. Crowds gathered outside brokerage houses, watching ticker tape roll. Today, speculation is digital. Instant trades, algorithmic bets, derivatives layered upon derivatives. Speed magnifies fragility. When sentiment shifts, there's no time to react. Markets now move faster than understanding. That velocity ensures the next crash. When it comes, will spread before most realize it has begun. But the most dangerous parallel may be psychological. Before every collapse, people feel safest. They believe in progress, technology, and control. Warnings are dismissed as negativity. In the 1920s, those who sold early were ridiculed. In 2025, those who warn of bubbles face the same scorn. Confidence blinds, complacency grows. And then one day, something snaps. A default, a failed auction, a sudden liquidity shock, and the illusion vanishes. But history isn't fate. The lessons are there. Spread risk. Question consensus. Remember that value depends on trust, and trust requires discipline. Systems fail not when markets fall, but when people forget why they rose in the first place. In 1929, no one imagined a decade of depression. In 2025, few imagine anything similar. That's what makes the echo so dangerous. Familiarity creates blindness. So as debt rises, speculation intensifies, and inequality deepens, ask yourself this: are we truly wiser than those who came before us? Or are we simply repeating their mistakes with better technology? When the dust finally settled after 1929, it wasn't just portfolios that were destroyed. It was faith. Faith in markets, in leadership, in the belief that effort alone guaranteed prosperity. The collapse forced nations to rethink everything they believed about money and power. The United States reinvented itself through the New Deal. It introduced regulation, deposit insurance, and social safety nets. These changes didn't end the Depression overnight, but they slowed the bleeding and set new rules. For the first time, the state accepted responsibility for economic stability. Yet even those remedies carried the seeds of future fragility. Once governments realized they could influence markets in the name of stability, they never truly stopped. Look at where we stand today. The foundations laid in the 1930s still shape the modern world. Central banks inject liquidity whenever panic appears. Governments spend trillions to stimulate demand. Investors now expect rescue. Moral hazard has become permanent. Risk is shared by society. Reward, however, remains private. In 1929, this idea would have seemed unthinkable. In 2025, it is simply assumed. This is how history drifts, from emergency responses to permanent doctrine. What was once extraordinary becomes routine. The Great Depression taught leaders one clear lesson: deflation destroys economies. When prices fall, people hoard cash. Businesses delay investment, and unemployment spirals upward. To avoid that outcome, modern economies accept inflation as normal. But this tolerance comes at a cost. Ongoing inflation eats away at savings, rewards debt, and punishes caution. It quietly transfers wealth upward, from savers to borrowers, from workers to asset owners. The system now depends on this invisible shift. It cannot allow prices to fall, even when reality demands correction. That's why modern crises end with bailouts instead of bankruptcies. In 1929, markets were smaller. The damage, though devastating, was largely national. Today, the system is global. Capital moves in milliseconds. Derivatives bind banks across continents. A policy mistake in Washington can ripple to Frankfurt, Beijing, and Sao Paulo within minutes. The interconnection designed to spread prosperity now multiplies danger. When one link breaks, contagion spreads instantly. That's why even minor crises create global tremors. The structure magnifies every shock. The Great Depression reshaped world politics. Economic collapse fueled nationalism, protectionism, and conflict. Desperate populations turned to strong leaders who promised certainty. In our era, the parallels are growing clearer. Economic anxiety breeds political extremes. Populism rises. Trust in democratic institutions erodes. When people lose faith in fair opportunity, they seek control. Any control. That was true in 1933. It remains true today. The original crash began with the belief that markets could fix themselves. Now we cling to the belief that governments can always intervene. Both beliefs are illusions. No system can escape arithmetic. Debt that exceeds income, speculation that exceeds production, promises that exceed reality. These forces always resolve the same way. The longer denial lasts, the harsher the reckoning becomes. In 1929, few understood how deeply finance was connected to everyday life. A farmer in Kansas couldn't see how Wall Street leverage affected wheat prices. But when credit froze, his livelihood collapsed. Today, the connections are more complex, but just as real. When central banks tighten policy, mortgage rates surge, housing cools, and jobs disappear. The feedback loop is faster, and the impact cuts deeper. Ordinary people, not algorithms, pay the price. Technology has changed the scale, but not the nature of crises. In the 1920s, ticker tape spread prices with delay. Today, algorithms act instantly without judgment. Fear and greed, once human emotions, are now automated. This makes modern crashes more violent. When machines detect a decline, they sell. When they sell, others follow. Liquidity vanishes in seconds. What once unfolded over weeks now happens before markets even open. The cycle has compressed. The consequences remain unchanged. But there is another lesson from 1929, a lesson of resilience. From collapse came reform. From despair emerged innovation. The challenge for our generation is to adapt before disaster strikes, not after. We already know the warning signs: unsustainable debt, overinflated assets, deepening inequality, excessive confidence. We also know the solutions: fiscal discipline, investment that creates real value, prosperity that is shared, not concentrated. What's missing is the will to act. It's easier to delay the pain, to borrow another trillion, to authorize one more rescue. But every delay only magnifies the eventual reckoning. When you study 1929 closely, one pattern appears again and again: denial. Journalists brushed off the early declines as healthy corrections. Politicians described the turmoil as temporary noise. Bankers reassured the public that fundamentals were strong. By the time reality was acknowledged, it was already too late. The system had fractured. That mindset, the refusal to believe, never goes away. It surrounds us once again. Market optimism remains elevated. Valuations seem untethered from reality. Central banks promise control and stability. Yet beneath the surface, pressure continues to build. When future historians examine our era, they'll ask the same question we ask about 1929. How did they not see it coming? The answer will be familiar. They did see it. They simply chose not to believe. Comfort is easier than correction. That is the core lesson behind every collapse. So where does that leave us now? The global economy stands at a familiar threshold. Growth slows while debt accelerates. Inequality fuels frustration. Institutions weaken under strain. Technology speeds everything up. The pattern is old. The setting is new. The Great Depression taught that collapse isn't only financial, it's moral. When trust disappears, systems fail. The challenge today is preserving that trust before another reckoning takes shape. If you've stayed with me this far, pause for a moment. Look at your own economy, your savings, the prices you pay, the opportunities in front of you. The ghost of 1929 doesn't live in history books. It lives in every choice to chase profit without substance, in every decision to ignore warnings for comfort, in every moment when speculation is mistaken for growth. Crashes don't appear out of nowhere. They form quietly, inside shared beliefs. So ask yourself this: if the conditions of 1929 returned, would we recognize them? Or have we built a system so complex, so confident, that it can no longer see itself clearly? The answer may determine whether the next decade repeats the past or finally learns from it. If this changed how you see today's economy, share your thoughts below. Are we truly wiser now? Or are we walking the same path in better suits? Your perspective matters because history isn't finished. It's replaying itself slowly. If you want more videos breaking down stories like this, make sure to like and subscribe. Thanks for watching.